Do you ever wonder why price moves aggressively at key levels? You might have done your best to mark out highs and lows in the markets, areas of supply, demand, support, resistance. Yet when you place your trades, price just blitzes through your stop loss and you get traded out of positions before moves occur. It's probably because you're not getting a good read of both order flow and how institutions are entering and exiting the market. Now, I'm going to talk through in the next sort of 15-20 minutes the basics of order flow, what it is, how to identify it, how to trade it, and then we're going to look at a couple of examples both for Bitcoin and CADJPY. We are focusing this content on swing trading, but this applies equally for day traders on lower time frames. So the logic applies across all time frames simply because price is fractal. So let's start, before we dive onto the charts, with a bit of theory. What is order flow? So the definition I've just marked here. Order flow shows you where large institutional orders are being filled in the market, revealing the why behind price movement. So for anything like me, I learned to trade and I learned some of the basic concepts of trading, but I always had this urge to understand why is price moving in a certain way. What is actually the meaning between demand being in control, supply being in control? What is price actually trying to do beyond just looking at patterns in the chart? And that led me to order flow, studying order flow, and then understanding the relationship between order flow, liquidity, and the higher time frames that you're trading. And that's what I'm going to walk through today. So why does order flow matter? Institutions fundamentally move markets. So our job as retail traders is to ride the same moves in the market, the same positions. We want to trade with institutions because, and I'll go on to explain, retail traders do not move markets, institutions do. And so by understanding how order flow exists in the market, or what's happening with order flow, we can look to ride those same moves in the market. Secondly, discover price moves with conviction. This is essentially meaning that you want to discover those that price action that actually leads to big moves in the market. Regardless of what time frame you're studying or trading on, you want to be taking high probability trades. And if you understand order flow, you're more likely to take higher probability trades, which is going to increase your win rate and ultimately lead to more profitability in the markets. And thirdly, truly understand the meaning behind what price is trying to do. You can get a lot wrong if your bias is correct. So if you have a good read of higher time frame bias and understanding who's in control of price from a demand and supply perspective, then you're going to drastically increase your chance of hitting profitable trades. So what is order flow? It's just understanding from a institutional perspective whether demand or supply is in control of the market and for what reason. And why does it matter? Because we want to leverage that to become better traders. Very quickly, institution versus retail trading, just to sort of bring this to life. Retail traders, if you think about if you are a retail trader, if you think about the sort of volume of trades that you're taking, it's not going to move these big forex markets or any type of market where there's a huge amount of liquidity. Big retail traders might be trading anything from 100 to 1,000 units per trade. You're not even going to see that on the candlestick charts that you're analyzing, especially looking at things like swing positions. To move these markets substantially, it takes large institutions like banks that are transacting hundreds of thousands of units per trade. So fundamentally, retail traders, when they enter the market, when we enter the market, no chart impact. When institutional traders enter the market, they leave a footprint in the charts. And that's essentially what we're reading when we're looking at technical analysis. And one of the underpinning things that we want to look for is order flow. And we can see that through these types of things. So first and foremost, if you are a large bank or an institution, whatever it might be, and you're entering the market and you're transacting big volumes of units, what is that going to look like on the chart? It's going to be more volume, And we can see that through aggressive price action. And we've talked in other videos about what aggressive price action leaves on the charts. Essentially, imbalance between price. So if price is moving aggressively, it's leaving behind demand or supply in the market that cannot get tagged into their positions because volume or price is moving away in an aggressive fashion. So we can read that on our charts. We also want to see the formation of supply and demand zones, because these can be created in order to manipulate, but they fundamentally cannot be, they are created in the process of volume and aggression coming into the market naturally because of the way institutions want to enter and exit positions. If you're a big institution and you're looking to fill hundreds of thousands of units, the way that you would look to do that is start to accumulate your position in the market, show that aggression into the market because you're filling those orders, and then let price retrace back to another acceptable level that you then want to enter more position size. That just simply looks like demand or supply zones being created, price moving away from those zones, retesting them, and then moving in the same direction. So by measuring volume and aggression, by seeing the formation of supply and demand zones, we can start to plot where we think institutions are gaining control of order flow in the market. And then finally, candle wicks, importantly in context. This is something that I'll just bring to life in the examples, but I think it's also a very important way that we can, or a tactic that we can use to identify order flow and also make sure that we have a good understanding of where price is heading and rejection areas in the market. So let's look at starting to identify order flow on the charts. So I'm going to pick up firstly with Bitcoin and then look at CADJPY. As I said, I could pick up any market here and show you the same thing. I'm just going to use the daily time frame for ease, and then we're going to look at some higher time frames and piece together how this order flow on one time frame might correspond with order flow on a higher time frame. Very quickly, I just want to bring you back, if you haven't seen the fair value gap video that I created recently, to fair value gaps. A very easy concept to understand. If you're new to them, don't worry that it's not anything that is going to be too difficult to capture, but I just want to bring this back before we actually get into some examples. So I'm just drawing a very basic 3-candle pattern, and this pattern is not something to focus on. What is to focus on is the fair value gap and the meaning behind what a fair value gap is. So we have candle 1 here, we then have candle 2, assume this is a bearish candle, candle 3. And what we get left with is an imbalance between candle 1 and candle 3, a fair value gap. So we can use this fair value gap to understand in this 3 candles what is happening. We had accumulation to an extent, then we had supply enter the market and overwhelm demand in an extreme way. Because again, if you go back to what is going to, let's take Bitcoin, move Bitcoin from 74,700 and whatever to $83,000, that is going to take a substantial entry of demand, orders, bullish orders into the market that creates that expansion candle. So we know through the just seeing that expansion on the chart that new orders and acts of aggression from large financial players are entering the market. Once we get a close of candle 3 and we see this imbalance, we then know that there was liquidity or a gap in price that is yet to be filled. Because what's happened is substantial demand has come into the market, and now what we're probably going to expect is a retracement, potentially, into this fair value gap to go lower. Now, if we just understand that this is aggression in the market, We could take the time to look at volume indicators and try and measure when volume is coming in and out of the market. We almost don't need to, because we know that in order for this candle to print, volume has to be in the market. That there's no way for that candle to print in that fashion without substantial demand coming into the market. So with that very simple logic, we can then start to use fair value gaps to understand at a broad level order flow. And let me show you how this works. So if we take Bitcoin in this particular phase of price action, so let's just take any area here whereby we have this retracement right here. So price is retracing into this level, and you can look at things like market structure. Ignore that for now, just purely look at price action. So we had, actually if we even start here, we had bearish price action, retracement, then we had this slight sort of consolidation, new bearish price action. Then we've got this pullback, this corrective pullback, and then we get breakout, which actually fails, shift bearish, close below, and then we get a new low targeting this low here. Now, looks a bit confusing, but if we just take the concept that I just discussed, where is aggression coming into the market? So we can see this huge down move here. What's created in this area? Fair value gaps. So we have fair value gaps, as there's an imbalance right there. There's an imbalance here as well, whereby price then trades back into that imbalance. Yes, we have aggression, but we don't have any confirmed fair value gaps in this aggressive leg back. We just have aggression, big sell-off, aggression, big sell-off. And then what do we get? We get new fair value gaps. So I would argue that irrespective of what is happening here, if you just ignore for a second what is happening and just think about whether supply or demand is in control of this market, it's fair to say that from an order flow perspective on the daily time frame, we have supply in control. And even though demand steps into the market to defend this area, it never creates anything in these price legs, fair value gaps, that give us an indication that this bullish price action is going to sustain or is going to be respected. So what ends up happening is there is this additional surge, price then sells off again. And in doing so, it creates bearish fair value gaps. So there's two in this leg again. And then what happens? We see this corrective move back, and in all of this consolidation, no fair value gaps until we do in fact get a bullish fair value gap. So at this point here, we can say that there is potential bullish order flow. There is potential bullish order flow. In order for this to confirm, what you'd want to see is a retracement into this leg and then additional bullish order flow off of this price action right here. Because what we're essentially seeing is bearish price action with fair value gaps, bullish price action with fair value gaps. But if you just wait for one additional price leg, you see the creation now of bearish price action again with bearish fair value gaps. So we can then assume at this point, okay, we have the potential that bullish price action is coming into the market, bullish order flow. But as soon as this order flow leg is created here, this price action leg, we then get more bearish fair value gaps. I'll just move these aside so we can see. Right, here we get more fair value gaps opening up in a bearish fashion. We get a retracement again into this area. This high is never disrespected. And then eventually this fair value gap, this imbalance in price is respected. And then we get an additional price leg lower. So very conceptual at this stage, but what we can say is that bearish order flow is in control of this daily market. Price leg down, and if I actually just take all of this away now, because it can get a bit messy, and we just look at the path of price, we have one leg down, one price leg down, where order flow, bearish order flow is in control. we get a bullish rejection, then we get another price leg down where bearish order flow remains in control. We get a correction. Yes, there is potential order flow developing here. I'm going to go on to explain why we wouldn't want to take notice of that. Then we get more bearish order flow, retracement, more bearish order flow. So if you're only trading order flow, you only at this point here want to be taking bearish trades. And we can look at different ways of executing this, whether this is good or bad price action to trade. But fundamentally, if you only want to trade with order flow, you should only really be interested in, at least on the daily time frame, bearish trades through this price action. Then what we see is that eventually we get this thrust candle here. We get the formation of a new supply zone, an order block right here. So then what happens is that price respects the order block and closes above. And in doing so, we then see the creation right here. It's a bit hard to see in comparison to others, but a new bullish fair value gap. So in the same way that we had bullish order flow coming in here, we get the same type of pattern. And what happens here is that price respects the liquidity in this range here and then trades higher again. And then it does the same thing again and again and again and so on. And if we just map within this the aggressive areas, the aggressive price action, we've got first bullish fair value gap right there. We get another one right here, which gets traded into. We get another one right here, which gets traded into, respected. We get another one right here. Again, acts as support in the market to go higher. And then we get another one right here, which eventually fails. But we can see that shift from bearish order flow coming up, down, new potential order flow coming in the creation of this demand zone. Talked about measuring supply and demand zones. We can see right here, this is a daily order block right here, that price had to create the formation of this demand zone because we had sell-off buy, which left the order block, the imbalance, which price then tests, before creating price action higher with a fair value gap. We then get another extension of price, new fair value gap, so we can confidently say at this stage that bullish demand is in control of this market, bullish order flow, again, price leg higher, fair value gap, retracement, and so on. So I'm laboring the point somewhat, but what we're looking for is aggression in the market. And what I've found to be the best indicator of that is fair value gaps being created in price legs that ultimately get respected. Now I'm just going to bring something onto the chart, which is now going to really bring this to life. So there are two things when you want to measure order flow. One is the formation of aggressive price action seen through fair value gaps, in my opinion. And secondly, the formation of supply and demand zones that you can trade from. Secondly, and probably more importantly, is liquidity and higher time frame candles, because we're ultimately trading candle ranges in everything that we do. And I talk about this more on other videos. But essentially, what happens at this specific level is that we liquidate, I'll just bring this up as an additional color, the low of this monthly candle. So when we get this price action in, this high, low, we liquidate a key area for Bitcoin. We then see a shift. Then we see bullish price action coming into the market. So at this stage here, we have a very, very high probability trade. So irrespective of where you want to get in here, let's just assume that we get in. We now have two things. We have a floor for price that is going to be respected because we've seen that there's been a liquidation of a low. We've seen now through confirmation an order flow shift. And we now have a very clear target for price. This candle's high, the liquidation candle. And arguably, we saw a liquidation of this candle. We've seen an order flow shift off the base of the subsequent candle. So from a swing position perspective, that target definitely becomes exposed to be targeted. And straight away, you've then got, even just using the daily time frame, without thinking about lower time frames or too much time frame correlation, a high probability trade that you can take by simply measuring order flow. Okay, so this is first concept, and hopefully that's starting to make sense. We're going to spend a lot more time on additional videos looking at trading this internal range liquidity. But to stay on track right here, I want to do the exact same thing with CADJPY, looking at order flow again. So if we just take the exact same premise, we have bearish order flow right here in this price leg. So we have a fair value gap, aggressive price action down into this level. Then we see right here a retracement into the fair value gap, which gets respected, a failed close below the low, and a market structure shift. What we then see is the creation of fair value gaps lower. Okay, so this is where it can start to get confusing, and this is going to emphasize why it's so important to analyze order flow in combination with higher time frame context. But let's just take this for now. So we then get a move bullish, another move bullish, retracement, failed close above the high, and a shift. So if we just track within this our fair value gap, so we have bearish price action, bearish order flow, tries to go lower with additional bearish order flow, creation of a new bullish fair value gap. So you've got candle 1, candle 2, imbalance, trades into the imbalance, gets respected, goes higher, more aggressive price action, bullish fair value gap, price trades in, trades down deep into this order block, tries to go higher, fails to go higher from this fair value gap, shift, and then you get new bearish fair value gap. And you actually have a second one right here. And you'll notice the candle wicks that are liquidating these fair value gaps, these imbalances in price. But we've essentially seen bearish price action, the attempt to stay bearish for bearish order flow to remain in control, bullish order flow step into the market, sustain, fail, and then shift bearish. So that in isolation gives you a read on who's in control from an order flow perspective of the market. Then again, if we overlay our candles, we can see what is price doing at this specific level right here, and what is price doing at this specific level right here. So when we get this bearish price action in to this low, we are liquidating this candle's low, this prior monthly candle's low, and we are also liquidating this prior monthly candle's low. So we have the completion of a monthly CRT, which is something I discuss in other videos right here. Then we get this shift, high, low, high, fail close, close above. Then we do get some bullish price action, which we'll go on to explain, but ultimately bullish order flow has entered the market to sustain this pullback essentially. We would then expect bullish price action to sustain. Soon as this monthly candle closes right here, we have new higher time frame context. So the start of this new candle starts bullish. We get a retracement into this order flow right here, fails to sustain and closes bearish. liquidating the high of this candle's range. So straight away, we expose this low in the market to be targeted. So again, if we just take daily positions right here, we're not thinking about refinements at this stage. If you just want to cover the fair value gaps, you can, or you could cover the liquidation of the candle, and then you can target the low right there. So it's essentially a 2R trade. And what happens is that price action then respects cleanly the order flow in the market to trade towards that higher time frame target. So we get eventually the respect of the bearish fair value gap, and then the formation of new supply and demand zones, in this case supply zones, that then get respected. So in fact, price just liquidates the low straight away. And just to mark these on right here, this is, check out my other videos on order blocks and breaker blocks and fair value gaps to understand points of liquidity in the chart. But right here we can mark the daily order block, that last buy to sell candle, and then we can do the exact same thing right here. There's a new daily order block. We then get sell off, new daily order block right here, and then again daily order block right here. And each of these levels just gets respected. Price trades in, retraces, trades out, retraces, trades down, and hits our target. And all we need to do in order to understand this context is map where is aggression from an order flow perspective, what highs and lows are we liquidating, and in doing so, when we see those shifts, what lows are we exposing or highs in the market that we can target. And just with that information, you can be very profitable in the market. Of course, you can then look at multi-time frame analysis, refinements on lower time frames. There is a lot that you can do to make these entries and exits in the market, more refined. Finally, if this isn't obvious already, always take a view of candle wicks in context. If you take a look at the higher time frame right here, so this monthly candle, you can see that very clearly in the order flow shift that we're liquidating. I'm just going to mark this again, it's a different color, the high of this candle. And if you're new to this, you can see that this is displayed in a wick on a higher time frame. So as soon as we get this type of shift, you get the wick of the higher time frame candle, in this context the monthly candle, showing you that visual shift from a higher time frame perspective of bullish price action coming into the market and bearish price action going out in this instance. And the exact same thing happens right here. So price comes in to create that top wick, then we get the shift right here, and you can see the actual market structure shift right here to take notice of is this low being initially respected and then disrespected. As soon as you do that, you have confirmation, order flow, because you can see the aggression here through the fair value gap. You have a wick right here, which is in context, it's liquidating its previous candle. So we're exposing lows in the market. And we held to this low. If you then start to factor in things like candle science, maybe you have context to target the low at this point here. And then just using one time frame, again, cover the liquidation, and you have the right context, the right targets, you've suddenly got an incredible swing trade opportunity. So this is how you start to think about order flow in your charts. For confirmation, this happens on every single time frame. So there is order flow on the 1 minute time frame, the 5 minute, the 15 minute, the 4 hour, the 12 hour, the 1 day, and so on. Your job as a trader is to understand, are you a day trader? Are you a swing trader? Are you a scalper? What higher time frame candles are you analyzing? What time frames are you using to measure price action to take trades? and then combining order flow with supply and demand zones, the formation of liquidity sweeps, and clear targets in the market that you can trade towards. Sounds like a lot. I have a lot of information coming live on my YouTube channel. Start to digest this content and piece it together, and you will see your profitability in the market skyrocket. Just going to close now with just some must-haves and mistakes that I see around order flow. Order flow in isolation, the creation of fair value gaps in isolation mean nothing. Higher time frame alignment, it has to be in line with higher time frame alignment, and that is having that combination of your price action on lower time frames with higher time frame candles and concepts, trading ideas. Again, trade in line with higher time frame liquidation. So if you see aggressive price action into a level, aggressive price action out of a level, look to see what are we actually liquidating, what is price doing. If it makes sense, then you probably have a trade. And always wait for confirmation. Wait for order flow to confirm before you start actually making an assumption that that shift has occurred. Common mistakes: don't do the opposite. Don't trade order flow in isolation. Don't ignore liquidity. Don't ignore multi-time frame analysis. And always wait for confirmation. So this has been a whistle-stop tour of order flow, how to measure aggression in the market, and that, in my opinion, constitutes order flow. What to look for to identify order flow. We've looked at some examples with Bitcoin, with CADJPY. We could do this all day long, and you would see these examples play out time and time again. As I say, I have a lot more content on all things trading, especially swing trading. So please check it out. See you on the next one.